Okay, welcome everybody to this next section in our trek through monetary policy and how currency works. In this video, we're going to talk about the dollar, U.S. our monetary policy here in the United States. So, if you are not already, please please subscribe to my channel here. So, like CFO Dad. You can enable notifications for when I go live. This is probably, I'll have at least one more in this series on currency, on the dollar. But in this video, we're going to talk about how the dollar works. So we're going to talk a little bit about how monetary policy in the United States works. And it's, I'm going to try really hard not to let politics get involved in this, but it's going to be really difficult not to. Just based on some of the things that I'm going to talk about. So to start with, though, I'm going to give you a brief history of the dollar and how we kind of got to where we are with the dollar. I gave a history of currency, but this is going to be a little bit more specific to the dollar. And now I'm skipping over a lot. It's really difficult to know what to say and what not to say. But going back as far as 1792, you have the Coinage Act. And in the Coinage Act, that enabled the U.S. to mint currency. And the currency that was minted was made out of gold and silver, and that's what they used as their money. Now, it wasn't the exclusive money or currency that was used in the United States back then, but it did enable them to create money, and they did, and it was gold and silver. And so it wasn't until 1863, and this is after the Civil War, that the U.S. dollar becomes the primary currency of the U.S. And all other currencies, so Confederate money, other types of currencies, there was not just other Confederate money, there were other types of currency that were used in the United States, but they all got consolidated into the dollar, and so that all the other currencies were converted to the dollar, and that was the National Banking Act of 1863. In 1900, there was the Gold Standard Act, which made it possible for the Treasury to issue notes or paper money that was backed by gold in actual vaults. So at one point in our history, we truly did have a gold-backed dollar, and that was around until the Banking Act of 1933, when the dollar was no longer directly convertible to gold by individuals, and so countries could do it, and they did a lot. Countries converted a lot of their U.S. dollars into gold, and at some point, actually in 1971, Nixon breaks the convertibility of the U.S. dollar to gold, and it's forever broken since then. And so in 1971, Nixon made it official where you could not redeem your dollars for actual gold. Okay. So backing up just a little bit, we have in the United States, we have the Federal Reserve. Okay, and the Federal Reserve is a central bank. Okay, and a central bank has the ability to basically dictate monetary policy for the entire United States. And so the Federal Reserve is the central bank. They have the sole authority to issue new currencies or to issue new currency. And this was established in 1913 by the Federal Reserve Act. Okay, and it opened the door even more widely than it was already open to break the connection between having a gold-backed currency that backed up our money supply. And the job of the stated job of the Federal Reserve is to control inflation and to provide stable monetary policy through providing liquidity to banks. And so they affect these things. They affect inflation. They affect the amount of liquidity in the market by changing what's called the overnight rate. And the overnight rate is the rate at which banks can borrow and lend money to each other, basically, and to and from the Federal Reserve. And so they control the amount of liquidity in the market by affecting those or controlling those interest rates. And so here I'm going to try to give you a simple example of how our monetary policy works practically. So you think, where does money come from? How does more money get created? Like, we've been talking about pretty much every time how the Congress has appropriated $2 trillion, and they just presented another $2 or $3 trillion bill to spend a bunch of money during the pandemic right now. So how would that work? So I just want to kind of give you an example of how this works, right? So if you look at the PowerPoint here, you've got the Congress. The Congress will appropriate spending, and so they'll write the bill, the CARES Act, or whatever the name of the new act is they just came up with, basically to give everybody $2,000 a month for the next 6 months. So Congress will appropriate the bill, and so here's the bill, and the bill goes to the Treasury, and the Treasury has the authority then to raise the money to spend it, right? So the Treasury will create bills and bonds, so basically debt obligations of the federal government. So they'll create, $2 trillion worth of bonds or bills to pay for the spending that Congress has appropriated, and they will sell these bonds on the open market. Now, what's going to happen this time is who's going to be willing to buy these bonds? Well, it's probably not going to be China, and it's probably not going to be too many Americans, though some Americans may want to buy some. But primarily, who's going to end up buying these are large banks who will then sell them to the Federal Reserve, but maybe just the Federal Reserve. Either way, the Federal Reserve is going to end up with a lot of these. With a lot of these bonds and bills. And so then where does the money come from that the Federal Reserve buys these bonds with? Thin air. They're going to write a check. They're going to credit the Treasury's account with $2 trillion or whatever it ends up being. And that's where the money is going to, when the Federal Reserve issues new currency, there's not a checking account they issue it from. They just create it. They just create an accounting entry and they create more money. Okay. And then they will have the bills or the bonds on their books, on their balance sheet, and they'll give the money, as it shows here, back to the Treasury, which will then give it to Congress to appropriate. And the Treasury will spend it how Congress has said they will. Okay. So that's when you hear people say Congress prints money or our government prints money, this is what they mean. So they are creating debt, they're selling it to the Federal Reserve. The Federal Reserve is, giving them money for this debt, new debt that they've created. And then they're using the money that they raised from the sale of the debt to the Federal Reserve on the things that was appropriated by Congress. Okay, so that's what we mean by that. Okay, so what's wrong with that, right? This seems like an orderly thing that happens, but what's really wrong with that? And so I want to give kind of a critique of it. And I will say that before I give the critique, I will say that, it's not necessarily that there are a lot of bad actors in the way this thing works out. People in Congress, people in power think they need to do these things. They think they have to do these kind of things in order to help people. And there may be some short-term benefit to it. But people have a hard time thinking about the long term. That's the case for not just politicians, but for individuals as well. Thinking about the long term is not a good thing, not something that we're very good at doing. So here are my problems with the way we currently do it, but then I'm going to give you some maybe ways we could make it better, maybe ways we could make our monetary policy better. So the first thing is fiscal recklessness. So U.S. monetary policy is fundamentally broken. There's no fiscal restraint to speak of. It's politically expedient. So here's the political forces at play in our monetary policy is that it's expedient to reduce taxes, which makes the short-term pain less for spending money because there's no pressure we would feel as taxpayers having to have an increased burden of taxes. So it's popular to reduce taxes and it's popular to increase spending. Spending cuts are only popular in theory, right? It's popular to say, I'm for being fiscally responsible. I'm for, maybe even people say, I'm for a balanced budget, which I'm certainly for a balanced budget. But it's politically popular to say that, but only in theory. When you start saying, well, I want to cut this, people say, no, we can't cut that. I want to cut this. No, we can't cut that. We certainly can't cut that. And so at the end of the day, what we end up doing is both sides of the political spectrum end up, compromising, and their compromise is they end up spending more on both. All right, and so the Republicans maybe they want to spend more on military defense. the Democrats are willing to do that as long as they get their social programs or whatever domestic spending that they want. And so the way the compromise happens is they agree to spend more on both. And so it's fiscally reckless. Our policy is by nature fiscally reckless. There is inflation and devaluation. As you increase the money supply, you devalue the currency, and at current rates of increasing the money supply, there's got to be a negative effect at some point. Okay, and as you recall from one of the early videos, I showed you my Zimbabwean $10 trillion bill. In fact, let me go get that. So, this is the kind of thing that can happen. You can see I know it's backwards for you guys, but this is my $10 trillion. So it says Reserve Bank of Zimbabwe. You can't read that backwards, but $10 trillion. Okay, so for those of you just tuning in, yes, I'm a 10 trillionaire Zimbabwean. But if you print too much, if dollars are not scarce, if they have no scarcity, then you're going to have inflation and you're going to have devaluation. And it's fine until it's not anymore, right? And so that's what I want to try to keep from happening, is that we have massive inflation and devaluation of our currency. The third problem I think that I see, and there are more, but these are the first three that came to mind, and probably the most impactful, is that you have a centralization of control. So one of the most insidious features of our monetary policy is the centralization of power and control of our economy, right? You've heard of too big to fail. You may have heard of, people criticizing picking winners and losers. Well, that's what this is. If you control the purse strings and you control where the money flows, then you can reward the people that you like and punish the people that you don't like. And that's a problem. If the government has a whole lot of control over that, then what if they don't like me? What if they don't like the industry that I'm in? Well, they can freeze me out. And there are examples that have happened in the past where rules, monetary policies have excluded certain businesses that the government doesn't like from being able to operate. And because they control the currency so much, they're able to do that. And so they have it. It ends up with them centralizing more and more power in the government, and that's dangerous. It's a dangerous thing when that much power can be concentrated in the government in just a few people. And so, what's a better monetary policy, and what are some ideals of monetary policy that would be better than what we have right now? Well, I think a monetary policy that's decentralized would be better, kind of like what I just talked about. Since the power is so centralized in the federal government with their ability to spend money and direct money where they want to, it's dangerous. It's a danger to the populace if that happens. And so we should seek a more decentralized monetary policy. So new money, or the issue of money, should come from community trust. So it should kind of arise, kind of like I talked about in the philosophy of money. Money only has value because people trust it. And if you no longer are able to trust money, then the value of money, whatever money that is, will decline over time. Okay, and so our money shouldn't be manufactured by strong arm tactics from a centralized authority. So it shouldn't be, this is your money and you're going to like it, and this is the money you're going to use for everything. It should be decentralized. So there should be competition. Next point, there should be competition in our monetary policy. Allow competition among currencies. Allow people to decide where. So again, we just want to let people put their trust where it should go, which is where they think it should go. If the dollar doesn't win your trust, then you shouldn't be required to use it as a medium of exchange. So if you'd rather use gold or silver or cryptocurrency or some other commodity-backed currency, there ought to be freedom for people to use whatever currency they like. And that will, because when you do that, if you made other currencies able to compete with the U.S. dollar, what would that do for the U.S. dollar? It would make it better. It would force the politicians to have to be more fiscally conservative. more and not fiscally reckless as opposed to fiscally reckless. And so there should be competition in our monetary policy, and that would make it better. It should be fiscally sound. There should be accountability for the people who issue the currency, such that the people that inflate the monetary supply should participate in the cost of doing this. So right now, there's no penalty for people being reckless in their spending. In Congress, at the White House, there's no penalty for them spending too much money, and that's a problem. And so we need to find ways to hold people more accountable. And so as it is, there's no penalty for being fiscally reckless. And I'm reminded of a Thomas Sowell quote, and I can't think of it right now, but just basically his point is that it's not surprising that people that bear no responsibility for the problems that they create, don't really care. Of course they don't care, because they're not the ones that are being affected by what they're doing. And so we should have a fiscally sound monetary policy. We should have a trustless monetary policy. Now, that may sound bad. You may think, well, why don't we want a monetary policy we can trust? Well, yeah, we do. But you want a trustless system. That is a system that doesn't require you to trust a third party, right? You shouldn't have to depend on a third party to make the monetary system work. We should have a system that's based on strict rules that can't be broken by a third party, such as the government or a custodian of funds. So basically, our monetary policy should enable people to be sovereign over their own money, okay? Without fear of a third party either devaluing it or confiscating it. That's what we should seek to do. If we wanted to really have the best kind of monetary policy, it should be a monetary policy that's free and open and that allows people to, hey, Dan Peterson, I see you there, buddy. We should have a monetary policy that allows people to be sovereign over their own money, over their own mediums of exchange. And so these are some of the things that I think would be good. We'll maybe delve into some of these more in a later video, but we will, hopefully this has been helpful, a helpful maybe thought exercise about how our monetary policy works, a critique of it, and then how we could have a better monetary policy of where we started. So just again, the brief history, we went from having a true gold-backed currency to now having what we would call a fiat currency. And when you hear that term fiat currency, what that means is basically the money is created or declared to have value by fiat or just by command, by just saying, here it is. So there's nothing backing the US dollar at all. There's nothing backing it except the word of the government. And that's what it's built on. And that's where the trust comes from, is from the government, for good or for ill. That's where the trust comes from. So we have in our country the Federal Reserve, which issues currency. It has the ability to control monetary policy, and it does so through this process that we've talked about here, where the Congress will appropriate bills, appropriate spending. That spending directive will go to the Treasury. The Treasury will issue the debt. The debt will be purchased by big banks, the Federal Reserve, other countries, individuals, wherever the money comes from. The money comes back to the Treasury and then is spent on the things that government wants it to be spent on. And again, the problem with the system as it is that it's fiscally reckless. So there's no real accountability on how much money is spent. It can cause massive inflation or deflation, or massive inflation or devaluation of the currency, which is a huge problem. And it also tends to centralize control and centralize power further in Washington, in the government. And that can be a problem because that gives the government massive authority and power over people they don't like, or over people they do like. It can control them, or it can reward them unfairly. And I think a better system, a better monetary policy system, should be decentralized, should be based on competition, should be fiscally sound, and should be trustless, so that we don't have to trust a third party, that we have control, we have sovereignty over our money, over our currency. So if this has been helpful, if you have any questions, please post them in the comments below. Like this video, share it if you will, on your personal Facebook page or on YouTube if I post it on YouTube later. So thank you all for coming. I hope to see you in the next video of CFO Dad, and thank you all again.